Hello, everyone. Welcome. This is Randy Packett. Most of you know who I am. This is our fifth webinar. Just to let you know that today is an audio-only webinar, so you're not going to be seeing our faces anywhere, but you will be able to see and hear the information that will be given by Mark DiOrio. He's our speaker today. I want to welcome you, and I want to thank you for joining us today. Just to let you know the couple of things. One is during the presentation, if you have any questions, if you please put your mouse over to your screen and bring it down to the bottom. And there's a section with the Q&A on it. If you click on that, you'll be able to write down, send in the questions that you may have. And then at the end of the webinar by Mark, I will be since I'll be getting those questions, I'll be reading that, and Mark will be giving you the answers. And once that's done, we will, finish the webinar, and we'll get together hopefully in 2 weeks. Next one will be not on Wednesday. It will be on Tuesday, the June 30th. So if you want to kind of put that in your schedule, please do so. Just remember, next time around, 2 weeks from now, it's not going to be on Wednesday. It'll be Tuesday, the June the 30th. I hope all of you are doing well. It looks like we're slowly getting back to what normal is. You're able to go out, and I know restaurants are open at 50%, but I know it still is a serious time. So I hope that you're healthy. If you got anything that you need from us, please let us know. I want to thank you for being with us. And if you could just about another minute, because we're going to have some other people are trickling in. And then once about a minute from now, we get Mark to get started. So I want to thank you for being with us. Just hold for 30 seconds to a minute. Thank you. Okay, so let me introduce our speaker to you. Some of you have actually met Mark. Mark has visited us from Chicago. He's the Chief Investment Officer with the Brookstone Capital Management. Mark's been around for a long time. He's been in the investment business over 20 years. He's a CFA, Chartered Financial Analyst. I don't know if you know what that is, but it is not an easy thing to get. I could tell you. You got to be very, very smart to do that. Mark has a lot of different experiences in creating strategic asset allocation and portfolio constructions to having any type of individual portfolio management. And he belongs to the investment policy committees. And so he's got a lot of background that he could help you with. I talk to Mark a lot. I get a lot of good information from him. As most of you know, we get through Brookstone, they do the background check and all the research and things for us, so that when we put together our portfolio, Mark's there to help me through. So without further ado, let me introduce Mark DiOrio. Mark?
Thanks, Randy, and happy to be here. And just to reiterate what you mentioned, yeah, it's been a very enjoyable collaboration with you, and we've enjoyed a great working relationship these past several years. So just getting into the economy, I'm going to jump right in because we're basically at a mid-year market outlook. And of course, this has been a remarkable year on a number of facets. But I would just look at the shape of the recovery and to set realistic expectations. We've seen a lot of what I think would be unrealistic expectations being talked about, whether it's by economists, whether it's journalists, or other news media outlets that mention something called a V-shaped recovery, V as in Victor, meaning you drop and then you bounce all the way right back up to where you left off. That is wildly optimistic and is not our base case. We have a massive employment dislocation, and the history of these takes a long time to recover. And this is from an exogenous shock. I think that's important to remember. We had very low unemployment levels. And so this shock, the COVID-19, is what we call an exogenous shock. It was not due to a natural economic slowdown. So it's not. So we came into the market or this year from an economic perspective on pretty solid ground, and now we've had this shock happen, and it hit the employment sector, and we're not going back to normal. And so the shape of this recovery is going to be the shape of the employment recovery, which I think and Randy, you mentioned it, as we're opening restaurants up at 50%, well, obviously not everybody's coming back from an employment standpoint. So it's going to take some time, and so you'll hear economic growth is slow. It's still not back to pre-COVID-19 levels, but I think that's very normal. It's just going to take time, and that's the reality. Now, the economy and markets are a little bit different in this environment specifically. For one, you have fiscal stimulus. I'll mention there's two types of stimulus coming into the markets. And this is more important than earnings right now, because earnings have really been dislocated as well as the economy was shut down by the government to prevent further spread of COVID-19. The difference, fiscal stimulus, is from the government and goes on the government's balance sheet. So if you hear deficit spending, that's from the government's balance sheet, and Treasury handles that. There's monetary stimulus that is from the Federal Reserve, which is the central bank of the United States. So any monetary stimulus or spending from the Federal Reserve goes on the Federal Reserve's balance sheet. So there's two different balance sheets that you're looking at. Now, in fiscal stimulus standpoint, the difference from 2009 during the global financial crisis and the 2020 stimulus efforts, massively larger in 2020 and remarkably quicker as well. In the global financial crisis, it took 80 weeks really to pass and get implemented stimulus measures. And in 2020, it's taken 8 weeks, so much quicker, and the size of the stimulus is much larger. So just on the fiscal side coming in, you have it over twice as big, and I think there's a definite appetite in Washington to go even bigger. We've seen some headlines about that, and when I say bigger, in the trillions. So this is becoming a large percent of GDP, much larger than it was from the global financial crisis. Also, what they're approaching and some of the plans that they have are different, and really it's going towards job retention plans and business loans and some other types of programs as well. Now, in order for fiscal spending, and it goes on the government's balance sheet, the government issues treasuries to pay for the spending. One of the challenges that we've talked about on and off again, and it's not really a problem until it's a problem, but it's the fact that we're issuing Treasury securities, and so individuals, pension funds, other retirement plans, and foreign investors all buy Treasury securities because they're considered the safest. They're government-backed. You get the return of principal and the interest payment back. What has happened as we've been issuing Treasury securities over about the last 5 years, foreign investors have stopped buying our Treasury securities. So what that means is that the U.S. has to fill that void. So we have less foreign ownership of our Treasury securities as a percent of our Treasury issuance. Where the financing is coming from is straight from the Federal Reserve. And this chart on this page is just showing that the Treasury is issuing debt to record on their balance sheet, and the Federal Reserve, the central bank of the U.S., is basically providing the monetary stimulus to buy the government debt. So this is sometimes called quantitative easing or monetizing the debt. So the Federal Reserve is It doesn't work exactly like this, but people would say that it's printing money to buy the debt, so you're spending money, and it's not investment money from overseas or wherever those monies are coming from. And if we look at what the Federal Reserve is trying to do, and it's important to point out, the Federal Reserve has a dual mandate. Jerome Powell is the Fed chairman. Before that, it was Janet Yellen. Before that, it was Ben Bernanke. Before that, it was Alan Greenspan, in case you hear any of those names. But those are the Fed chairmen. Chairman Powell has been on 60 Minutes recently. Monetary stimulus is being used to fulfill their dual mandate, which is maximum employment and to maintain steady inflation and moderate long-term interest rates. So it's not actually an easy job. And the way they do it is they typically credit banks, or they regulate the financial markets. So the way they do this is through they increase or decrease interest rates. It's called the Fed funds rate. So the Fed funds is the rate that banks charge each other for overnight loans. So the Federal Reserve comes in and if they lower rates, it means they're trying to be more stimulative. If they raise rates, they're trying to restrict the flow of capital. They can increase or decrease the reserve requirement for banks. That's the percent that banks are required to keep on hand. They've since reduced that. That number rarely changes, but they've reduced that from a normal 10% to about 0%. And then they can, through their Federal Open Market Committee, go into the market and buy securities, buy Treasury bonds. So that's what they've been doing. They've also been buying mortgages, and recently they've actually been buying corporate bonds, including high yield, that's below investment grade bonds as well. So they put a lot of stimulus efforts in to the tune of about $3 trillion in the last 3 months. And that is what the market, the stock market, has responded to, all this extra liquidity coming into the marketplace. And they really did this, and the Fed's point is, we're doing this, we can't initially correct any of the employment, we can't cure a healthcare crisis. What we can do is stabilize the financial condition to allow conditions to allow the economy to work through this environment at this time. So this chart shows as the Fed was really increasing its balance sheet, putting more liquidity into the market, so it has about a $7 trillion balance sheet, up from about $4 trillion, really counteracting the losses that we were seeing in the private sector. One of the challenges that we have and have from time to time is the value of the dollar relative to other currencies. A lot of currencies want to devalue or depreciate relative to the dollar, so their exports to the U.S. is cheaper. At this point, the U.S. actually wants to lower the value, and that's part of the Fed's policy, and even Treasury's policy at this point, lower the value of the dollar to put a little bit of deflationary pressure off of us. So if the dollar was rising, you'd see some deflationary pressures. With the dollar declining, there's some inflationary pressures, and they want to inflate assets, or at least keep them stable, so you don't have an asset deflation spiral. That's kind of what we got into in 08, 09, where assets were, and housing, it was in a bubble, and then it deflated very quickly, and so you had nothing to back those underlying loans, or they were underwater. So they've definitely moved to the position where they want to devalue the dollar to put some pressure off that. And the implication is, well, you want to be an investor of the devaluing the dollar, because investments will benefit from that scenario. The value of stocks will go up. The value of other assets will slowly go up over time, as usual as well. So this is an important point, and we're looking for this. What happened acutely in March was a literal dollar shortage, where there wasn't enough dollars to go around. As businesses closed, as borders closed, the only thing that stayed open was the marketplace. And so those that needed cash now had to sell regardless of price. And that's exactly what happened, and it just drove markets down. They got the cash out. And the Fed came in as the lender of last resort, what they do to help stabilize those financial conditions. So there's literally a dollar shortage. You don't hear too much about that, but that's what happened acutely at that time. It really started, the famous one in history was 1907, where there was a big panic, and then J.P. Morgan came in and got all the bankers in a table or in a room and said, you have to fix this and spend all the money that you need to and get cash on the streets so that asset prices and conditions can stabilize. But that's what happened. So we'll be watching this and the value of the dollar going forward for sure to see what type of pressures and how well policy is working. And right now it's working very well to stabilize conditions. With that said, we'd expect, and what we've seen is interest rates have stayed extremely low, and we expect them to stay low for longer. Right now, we look at short-term interest rates all the way out to 10 years are below 1%. So the 10-year Treasury is actually 0.75%. So the government, even though they're borrowing through their issuance of Treasuries, trillions of dollars, the 10-year Treasury, they only have to pay 0.75% for a 10-year term. And about 1.3% for 30-year term. They don't issue a lot of 30-year Treasuries. That may change as we go forward. They do not want to go into a negative interest rate environment, but these are awfully low, and I think we would struggle a little bit with higher interest rates. So it is definitely important that interest rates remain low as we're taking on, as a country, so much debt in the immediate term to fix this situation. The equity markets have acted very interesting this year, but very concentrated, which may give to a misleading view of the markets. Tech stocks have done very well this year, partly because they don't really are not necessarily relying on the regular operating of the economy like many other companies, but because you can work from home and work different places, and you still use those technology sources and so forth. And they're in pretty good position anyway from a cash standpoint. But technology stocks, at the time I printed this chart, they were up about 5% on the year. Large cap stocks overall were down over 10%. But then if you get to small, mid-cap, international stocks, you're down 20 to 30%. So most balanced portfolios and diversified portfolios would hold small, mid-caps, and they just haven't recovered as well as some of those big tech names. Now, markets go in and out of cycles, and I would expect, just as previous time, these things reverse, and then another sector's day in the sun kind of takes the lead, and these reverse back and forth. But that's kind of the nuance that developed out of the crisis, and crisis kind of stemmed from a financial standpoint around March 23rd-ish and started to bounce back, but tech just happened to bounce back much quicker so far. When we look at other declines of this magnitude, most of them haven't been this sharp or this quick. However, when we look at how they responded after initial sell-off or decline, a lot of them from this point ultimately go sideways in a wide-ranging fashion. So you could have a lot of volatility, a lot of upside, a lot of downside on a day-to-day action. It was just last week where, in one day, which would have been very strange, but in this market it's not that strange, where the market sold off about 6% in one day. Very big, and then another day it rallied 4% higher. So these are anomalies normally, but we'd expect this, given how the market has started this year, to continue in a wide-ranging fashion. But ultimately, our base case would be for a sideways moving action, and that's how they work themselves out over time. And the key to this is really that stimulus has come in to take off the worst-case scenario out of play, and then we just have our natural limitations of what the market and the economy can do given the circumstances for the remainder of the year. And that big bounce back that we saw was about the fastest bounce back that we've ever seen in market history as well. Not that it bounced back all the way to its old high, but the magnitude of that move was quite sharp, which really goes to reiterate one of the key tenets of market sell-offs is that right around the worst days in the market, you'll find some of the best days in the market. The market will bounce back pretty sharply. You never know if that's the bottom or not, but that's how they typically work. So when we look at staying invested, and this is different, I always try to make a distinction between a trader and an investor. A trader is trying to make moves on make money on short-term market action. An investor is really investing in asset classes based on diversification principles, academic research, to benefit over time of the growth in the capital markets. But if you look at this chart, it shows if you stayed invested for 20 years, 98 through 2019, your $100,000 turned into $324,000, and this is the S&P 500. But if you missed just the 25 best days in those 20 years, your $100,000 turns into $82,000. And you never know when those best days are. But this is pretty good chart showing just if you missed a few days over that time, you really missed out on a lot of return. So it's important to stick to a discipline and understand that the market, yes, can sell off very sharply. It can also rise very sharply, and it will rise when there is bad news. Bad news does not necessarily preempt the market from rallying. So it's important to understand volatility this year is the 6th most volatile year in the last 100 years. The history of volatile years is that they remain volatile for the remainder of the year. And so that's our base case, and we really want to prevent investors from getting too spooked or too exuberant on any rally to make them make bad decisions in the face of some of this uncertainty. So this is just a macro backdrop, understanding volatility is going to be with us for the remainder of the year. There'll be a lot of narratives. I remember at the start of this year, it was a very quaint time when the big story was the election, and we haven't even talked about the presidential election for the first 2 quarters of the year. So in the 3rd quarter, we'll start to move towards the election, and then you have the possible second wave of COVID-19, how that takes shape. And so there's a lot more to the year left. One of the ways we've been mitigating and building portfolios to address high volatility periods is through something called smart beta. Now, smart beta essentially is a screening methodology to identify stocks that have certain characteristics. Each of the characteristics on this screen, min-vol, that's minimum volatility, those are lower risk stocks. Quality, those are companies with healthy balance sheets. Value stocks, momentum stocks, or size, smaller companies, more nimble companies. Each of those are called factors. And the one that really stuck out to us is minimum volatility because it met with a lot of our client objectives and a lot of our clients that like the idea of equities, like allocating to equities, but really want to do it in a less volatile fashion. And what low volatility stocks have done relative to the market is historically they've only shown a potential downside or a downside capture ratio of 54%. So about half of the downside on down moves. And then in rising markets, they've captured 73% of the upside. Well, that's enough to outperform the S&P 500 over time while taking less risk than the overall market. So what low volatility does is say you can stay invested in equities, have competitive returns, but do so in a less volatile fashion. So this has been very effective and a very popular approach that we've run for clients. And it's also an active strategy under the hood. What we call a dynamic strategy, meaning low volatility is not just a certain type of stock. It's how those stocks are acting in the markets, and then that's reevaluated every quarter. And then based on that screening methodology, which really just looks at what are the least 100 volatile stocks in the S&P 500 as an example over the last year. And that becomes a very good stock basket to show these are stocks that are enjoying good sector runs. The companies are well run, but that can change as conditions change as well. And so the chart on this page just shows that the allocations change within our minimum volatility suite. I mentioned low interest rates before, and we think low interest rates for longer as well. So that impacts investors looking for income. And when we look at stocks versus bonds, it's been a long time, but now we're at a point where stocks widely are yielding, their dividend yields are higher than the interest you would earn on bonds, especially comparable bonds. So AT&T is just an example stock. Their stock yields over 6%. They can issue bonds and pay bond investors 3%. So if you're looking for the income off of the investment, you'd say, wow, that's a pretty big difference in just the income generation of the portfolio. So this is an area we wouldn't ignore for income investors. We'd look for stocks that are, you'd look for high quality, attractive dividend yield, with the potential to pay and raise those dividends to shareholders. And just to put some facts behind it, data from 1972 to 2015 would show all dividend payers returned about 9%, while non-dividend payers returned about 2.5%. So there's a big difference over time in what types of companies pay dividends and what types of companies don't pay dividends. And the history is with those dividend payers because the dividend return is stable. So if you get a stock that has a 4% dividend yield, you're getting that 4% regardless of if the stock is going up or down or sideways. So that component of the return is very stable. So it also leads to less risk, and all the way on the right shows standard deviation, which just is a measure of risk in the marketplace, the higher being more volatile historically. So with Chesapeake has a dividend portfolio really based on these tenets, and it offers direct exposure to high quality dividend paying stocks, above average and reliable dividend income stream. And I think that's very important, where if you have with dividends, they're paid directly from the company to the shareholder. And the company determines, not the market, the dollar amount that shareholders will receive. So whether the market's up or down, as I was mentioning, it's the company that decides how much it pays in dividends to shareholders. Now, a lot of them raise their dividends annually. So Coca-Cola has raised their dividend for more than 50 consecutive years to shareholders. There are other companies like that as well that would be part of a basket like this, a dividend stock basket that says we want the dividend. And then if you raise that dividend and you get more income year after year after year, pretty soon that really snowballs into a lot of money. It actually creates a lot more income than a bond would pay you over time. So we're looking for companies that would raise their dividends to shareholders at a faster clip than the rate of inflation, and a lot of these companies have been doing that. So there's a lot of good selections here with good starting yields and also good prospects for raising that dividend as shareholders over time. And that doesn't always make the news because it's not the hot stock, but it is a consistent earner and very profitable for shareholders over time. Additionally, I think Randy might say a few words about this, and I don't know if you want to mention about the dividend stock basket, Randy, but also we're also collaborating on an aggressive stock basket as well to look at some growth stocks to add some of those disruptive innovators into a portfolio for those that might want to carve out some money to put into a growth-oriented portfolio. And other than that, I'd be happy to take any questions, or Randy, if you wanted to chime in.
Well, thank you, Mark. I think you did a great job explaining. As you said already, we are coming up with this growth stock portfolio. Hopefully we get everything ready to go by if not in the middle of this summer or end of third quarter. I do have a few questions that people have asked, and some of the questions kind of go together, so I'm going to put two of them together and ask you so you could answer this. He says that, I understand the Fed Chairman Powell is to testify before a House Financial Services Committee today, and it appears that the market becomes very volatile based on what he says or how he says things. What should Fed do for the rest of 2020 and all of 2021? In addition to that question, if you could kind of, one more, it was very similar, says, with all the decisions of keeping the lower interest rate and Fed buying the corporate bonds, and also having all the stimulus measures, is there any concerns of either deflation or inflation that we have to deal with in the next 12 months? Can you answer those things?
Sure. The Fed's dual mandate, and I say this just because they have to battle this. The Fed has a hard job, and a lot of decisions get kicked to them that wouldn't because it's easier for the Fed to operate than to get into a political discussion or determine. So the Fed's trying to keep maximum employment. So right now they have a major problem with all this unemployment going on. Then they have to keep moderate inflation and moderate long-term interest rates. So they have to balance all these. So on the unemployment front, they have to provide liquidity or money into the markets in order to stabilize those conditions and hope that that trickles down into more lending by banks and more employment when companies are healthy and confident, more employment. And then they have to make sure that inflation doesn't run away. Now, the reason the market moves on what the Fed chairman says is because monetary policy is probably the most important thing for asset holders, whether they're being accommodative, meaning lower interest rates and putting liquidity or money into the market, or whether they're increasing interest rates and trying to pull money away from the economy to stem off any excess speculation or the inflation risk where prices just get away. And that's probably from the late 70s and the 70s overall, that environment where the Fed really had to increase interest rates to stem that inflationary environment, and they did. So right now, they are definitely providing liquidity, and it's the right thing to do under the circumstances, given their mandate. There is not inflation issues yet. However, we do see the value of some assets have bounced back, definitely. In the stock market, it's obviously bounced back. And this is where I'd say you'd want to be an investor that would benefit in case there is an inflationary outcome. What the Fed will likely do is continue to provide all the liquidity that is necessary. I mentioned their balance sheet is $7 trillion. I'd expect that to go well over $10 trillion and not end there. So they're going to provide all the liquidity that's necessary. They don't really have much choice because the alternative is, geez, you pull away liquidity and asset prices really start to have challenges. But they have mentioned that as well, I would say. They've been very clear on this, and Chairman Powell has been clear on this, that they're going to keep interest rates low for longer to allow companies to heal and allow a healthy lending environment and companies to pay back loans and not be capital constrained in this environment. Because remember, it's an exogenous shock that was not necessarily just normal. What a normal recession would be was maybe you over inventoried, build up too much inventory, and now you have to sell that inventory down before you build it back up. So it's definitely not a traditional type of recession. It's a shock environment, and that's what the Fed's role is. So I do think there's a reason for investors to stay committed to investing because you have this liquidity coming in. They want to get the value of the dollar down, and they want some inflation, which has been actually hard to get. And not to complicate the answer, but they want to inflate some of the value of the debt away over time, and the only way you do that is to get some inflation, meaning that if you take out $1 trillion today, well, in 10 years, hopefully the value of that trillion is actually less, of course, when you have to potentially pay it back.
All right, got a couple more questions, and if you could, since we got about 2 minutes, next one is, can you please explain the difference between active versus passive money managers or money management?
Sure. That term was traditionally used when a firm called Morningstar really started to categorize a lot of different mutual funds. So this is in the 90s, and mutual funds, you could either be passive, which means you were index-based. So Vanguard was a passive manager. They just said this is an index of 500 stocks, as an example. They have several indexes, but of 500 stocks, and we're not going to actively manage it, meaning we're not going to pick the individual stocks. We're just going to say it's the 500 largest U.S. stocks are in that index, and that's the index. An active manager would say, and this could be, you could do it on the stock side or the bond side. So on the stock side, they'd say, you'd have a manager that would go in. The Fidelity Magellan was a classic one, where they'd pick the individual stocks. They may say, well, no, we like this stock over that stock, and we may hold it for a certain amount of time and then sell out of it and adjust regardless of what the index rules would dictate. And on the bond side, and I think active makes a lot of sense on the bond side because the bond market's a lot bigger, it's not as clear, and usually active bond managers do outperform over time because they can do a lot of credit research and find a lot of pieces of value. And so we do use a lot of active bond managers. And so those are managers that instead of just using the aggregate bond index, which is the broad index for bonds, they would go in and decide which bonds are better, higher quality, higher coupons, and then they can adjust their time to maturity as market conditions dictate, whether they want to be short-term, intermediate, long-term. There's different benefits you can get from there. What I would say is smart beta portfolios are kind of that next step where you actually blend the two concepts together. You take the best of both. So one of the good things about indexing was it was very efficient, it was low-cost exposures, and you had pretty good expectations around how that index would perform. So smart beta says, okay, we like that idea, and then we want a little bit better selection on those stocks. We think we can categorize the stocks a little bit better than just all 500 stocks. We want to pinpoint the types of stocks so that we can address investors' needs a little bit better. And so this is where the minimum volatility screen comes in and says, well, we want the minimum volatility stocks, so lower volatility stocks, blend that as an index concept, and put it in a low-cost package, an ETF, an exchange-traded fund. And then we can adjust those holdings every quarter, every 6 months inside the ETF. So you have a bit of an active component there, but it's based on index rules, so it turns out to be low cost and very efficient to use as well. So that's from passive, active, and then what we call smart beta now, and that's really probably this next generation of investment approaches.
Well, thank you, Mark. I want to thank everyone for joining us today. Just remember again, our next webinar will be on Tuesday, the June 30th, and then 2 weeks after that on Wednesday, we plan to have another one. Actually, I believe it's the 21st, 3 weeks after. So I want to invite you, and you're going to be getting an email, but just put it in your schedule to join us again. Mark, thank you for visiting us and going over this important information, and I hope everyone has a good week. Take care now. Bye-bye.
Thank you.